Hello, everyone, and thank you for joining us. Our webinar today is Determining Reasonable Compensation plus an RC Reports case study. My name is Adam Manson. I am the Director of Valuation Data here at BVR. Before we begin, I would like to remind you that your attendance today is eligible for 2 CPE credits. To receive these credits, there are 2 things you must do. First, please be aware there are simple polling questions during the webinar that are used to measure engagement. Polls are required by NASBA to provide you with CPE credits. There are 7 polling questions that will pop up at random times, and you will have 2 minutes to respond to each question. You will be alerted when a poll comes up with a ding sound and a note in your chat box. You must answer 6 of the polling questions to receive your CPE credits. The second thing you must do to get CPE credit is complete and submit a brief survey at the conclusion of today's presentation. A link to the survey is included with your login email and is also available on the event page for the program. Additionally, after this webinar, your browser will be redirected to the survey page. You'll need to complete and submit the survey within 5 business days to get your CPE credit. If you have any trouble with the audio streaming during the webinar, please refresh your screen, and that should fix the problem. If you have any questions for our presenters, we will take them in writing only. To do so, please use the chat function on the side of your screen. Our presenters will answer your questions at the end of their presentation. And now I would like to introduce today's presenters. Stephen Kirkland is the owner of Atlantic Executive Consulting, and since 1995, he has provided analysis, reports, and expert testimony to help determine reasonable compensation amounts for business owners, executives, professionals, trustees, and directors. The employers have included professional service firms, closely held businesses, hospitals, and a variety of tax-exempt organizations across the United States. Stephen has been engaged as an expert witness on reasonable compensation in more than 200 cases and has testified 5 times in U.S. tax court. Paul Hammond is the owner of RCReports and is an expert on determining reasonable compensation for closely held business owners. He has educated more than 30,000 tax advisors and valuators on the topics of reasonable compensation and has been published in numerous state CPA Society journals. Paul, along with other experts in their own fields, founded RCReports in 2010. RCReports cloud software determines reasonable compensation for closely held business owners and is used by CPAs, EAs, tax advisors, valuators, forensic accountants, and attorneys when they need to determine a reasonable compensation figure for a client. I will now turn this presentation over to Stephen and Paul.
All right, thank you so much.
Thanks, Adam.
Yeah, I'm Stephen Kirkland, and I see we have over 100 people participating today, and so I thank each of you for joining us and appreciate Paul being a part of this and BVR sponsoring it. This is a very timely and important topic. As I'm sure you know, there's a lot of contention over compensation, not just in business valuations, but otherwise. And it's a fun topic, so I think we'll have a good time going through this today. On the agenda today, we'll be talking about gathering facts, sources of data, specifically compensation comparability data, and making normalizing adjustments. We'll also be talking about approaches or methodologies that will be used. Paul's going to go through a case study in considerable detail and show exactly how you can obtain the data that you need. We'll also talk about the fact that determining compensation is not an exact science, but involves some subjectivity or professional judgment. We'll also talk a little bit about what you need to know if you're serving as an expert witness. And by the way, you might end up serving as an expert witness inadvertently if you prepare a report and that report goes to court. You may be called to defend it. And then we're going to reserve a few minutes at the end to respond to questions. I chose compensation as a field to specialize in many years ago, partly because it was so interesting. And I hope that'll come across today. You'll see that the adjustments that you end up making in your valuation reports can be quite large. Just to give you an example, the first time I testified in tax court, a business owner had been paid $400,000 a year. By 15 years later, we were back in tax court arguing over someone who had been paid $37 million in 1 year. So compensation amounts have gotten quite large in some instances, and that results in a very large adjustment affecting net income or EBITDA and having a tremendous impact on the ultimate value of a business. And it is subjective. We'll be talking about that. There's not a simple formula, and that'll be very clear too. Compensation is also very personal. If you're normalizing the owner's compensation, you may need to normalize also compensation paid to the owner's relatives. And if you want to know just how personal it can get, you go in and tell a business owner that their granddaughter is not worth what she's being paid, and you'll find out just how personal it can be. Also, compensation, of course, is very controversial. You can always start an argument with people at a party by just talking about executive compensation. And then you'll also see that it gets to be somewhat complex when you get into special situations where people are personally guaranteeing debt as well as working very, very hard. They have unusual expertise and unusual skills. They're signing debt covenants and so forth and so on. It does get to be a little bit complex. I wanted to mention that adjustments can be made for all forms of businesses. Years ago, we had a lot of C corporations that were privately held, not so much anymore. But with C corporations, of course, the owners of a successful company might be tempted to overpay themselves to avoid double taxation. But now S corporations are far more common. The IRS says that there's well over 5 million S corporations filing tax returns each year. And there may be a tax incentive to underpay to avoid some of the payroll taxes, particularly Medicare tax. And then nonprofits, of course, are another area where compensation is scrutinized. They have to disclose information on 990s, and that's available for the world to see. And then sole proprietors. It may seem odd that sole proprietors are on the list, but I've had a couple of engagements recently involving people who were going through a divorce, and they were into the MLM industry, multi-level marketing, and they were reporting that on Schedule C. Well, it is a business, and someone's got to determine what that business is worth. In order to determine what it's worth, you've got to determine what replacement compensation would be for that individual. And so you can find adjustments being made in just about any of these situations. Areas where I've used RCReports, and by the way, I am independent of RCReports, but I am a subscriber. Divorces, of course, very common in some instances. One member of the marital party might not be working at all, and you might need to determine their earning potential for alimony and child support purposes. Sometimes people are underemployed. They may be working part-time, and the court may want to know how much they could earn working full-time. Also, in situations like personal injury cases, you may need to determine someone's earning capacity. I had a situation recently where someone was injured in a trucking accident. He was between jobs, not working, and we can use RCReports to determine what his earning capacity really is. Okay, my recommendation to you when you're working on a business valuation engagement is to inform the owner of the business early that it is a very normal and common part of the business valuation to normalize owner compensation. If you wait until the end and they're reading your report and they see an adjustment for their own compensation, that sort of surprise might be a little awkward for them. They may feel like you're sort of picking on them or discriminating against them. I would recommend you just inform them early, even in the engagement letter, and just say it is very common to normalize compensation. Sort of explain in the engagement letter the process and ask them at that point for all related parties to be identified. It's a good idea to ask that question in writing. I heard a story of someone who prepared a business valuation and he did not normalize the pay for the second highest paid person, not realizing that she was related to the owner because they had different last names. And that was a big surprise when they got to court. So ask for all related parties to be identified, and you might even put that in your engagement letter and almost present it as a secondary type of engagement because it really is a separate process. And then on the subject of engagement letters, I'd also recommend you put in some language that says, if you ever get contacted later after you've completed your business valuation, you get contacted, you get subpoenaed, and you have to produce work papers or you're deposed, you're expecting the client to pay you for that time. In other words, you might prepare a business valuation report and say that Joe or Mary are overpaid. 2 years later, there might be a shareholder dispute, and one of the shareholders remembers what you said, and they send you a subpoena, and you get involved, and you don't want to be paid for that time. Okay, there's three common approaches, and that's the market, the cost, and the income approach. I'm going to describe these briefly, and then Paul will go through a case study in considerable detail and show you how these work. But the market approach is simply benchmarking compensation using industry data. If you look at the IRS regulations, they use the term like services at like companies. I don't really like to use the term like services and like companies because there are no two companies that are just alike. But the market approach is simply benchmarking and just the way you would do in a business valuation report, or if you were a real estate appraiser and you were appraising condos, you want to know the value of one condo, you'd look to see how much a similar condo sold for. And then the cost approach is similar to the asset approach in a business valuation, where you break down the components, determine the value of the components separately, and add them up. This is common where you have someone wearing different hats, so to speak. And then the income approach is often referred to as the independent investor test in the compensation world. And I would compare that to using a multiple of earnings in a business valuation. But Paul will be going through these approaches in more detail a little bit later. One of the things that I enjoy about working with executive compensation is talking to executives, interviewing them, and finding out just how they do what they do. I've had the opportunity to work with some very successful people, and I'm sure you have too, or if you haven't yet, you will. But it's very interesting to get on the phone with these people or get on Zoom with them and talk to them and find out what they do, how they do it, why they do it, how they've been successful. And of course, with small business owners, they do tend to have responsibilities in a lot of different areas. And sometimes you have to drag that out of them. I would compare that to if I was to ask you, what do you do for a living? You might say, well, I prepare business valuations. You might give me a short answer, but if I question you a little bit more, I'd find out that you also help with firm administration. You also help with business development. You also help with recruiting and training. And we have to do that sometimes with the business owners too. We have to question them to really bring out everything that they do. The sources of information, of course, are very, very important. We need to consider the reliability of the different sources. We can interview people. It's a good idea to talk to people who have firsthand knowledge if you can. Sometimes if something's in litigation, like in a divorce, you're not really free to talk to everybody. But to the extent you can interview people who have firsthand knowledge, that's helpful. And then financial statements, of course, are also helpful if the company has been audited, and there are footnotes to the report. The footnotes can be helpful, particularly with respect to identifying related party transactions that you need to know about. Tax returns, I think, are also very helpful because tax returns provide a lot of detail that is not found on the financial statements. And then websites are helpful, but be cautious. Some companies don't keep their websites up to date. Someone who's an e-tailer probably does keep their website up to date, but something like a construction company, they may not. A construction company's website might say they have projects going in 7 states. Well, that might be old news. It might not be up to date. Deposition transcripts are very, very helpful because they are obviously written, they're very detailed, and they're given under oath. And so those can be a good source of information if there are deposition transcripts available. It's helpful also to know how the historical amounts were determined. And to illustrate that, I'll just give you a quick example. If the business owner has been paid $2 for every widget that's manufactured and shipped, and that system is working well, and the company plans to continue using that system, then you'd probably need to apply that. If you're doing any kind of projected financial statements, if you're anticipating growth, for example, then you would also need to anticipate the CEO's pay is going to go up as the number of widgets goes up. Some of the questions that I would recommend you ask as you interview people is, are you multilingual? Now, when I testified in tax court the first time in 1995, I don't remember even asking the people if they were multilingual. I don't think it was very important at the time, or at least it didn't seem like it. Now we've got more people in our country and more small businesses that are doing business internationally that speak different languages. And so being multilingual can be a tremendous asset. And then, are you an effective negotiator? Some of these soft skills can be very, very valuable to a business owner. Being a good communicator, a good leader, a good salesperson, very powerful. And to determine someone's value, you need to know how strong they are in those areas. And then, how do you spend your time? I like to ask executives that question. Many executives do not track their time. You and I probably do, because that's how we build. But for many business owners, they don't track their time. And it's a good exercise for them to go through and break down their time between finance, HR, marketing, and so on. Another question I like to ask is, why would you be difficult to replace? I get some interesting answers to that question. I did have one person say I would not be difficult to replace, which was an interesting answer, but he felt like he had trained some of his other people to step in and replace him. And then, what else do I need to know to normalize your compensation? I'll tell you a quick story about that. I heard of someone who was doing a business valuation in a divorce setting. And the business owner was a licensed professional. And turns out he had lost his license to practice. And the business valuator didn't know that. And he asked later, why didn't you tell me you had lost your license? And he said, you did not ask me. And so that's why I like to ask a very broad question, like, what else do I need to know to normalize your compensation? That way, I am asking, if there's something that I need to know, here's your opportunity to tell me. If you look at the tax court cases involving reasonable compensation, you'll see that they talk about factors. Now, I know that not every business valuation report you prepare is intended for tax court, but nonetheless, even family courts, state courts, or other courts will often defer to the U.S. tax court on methodologies and approaches with respect to compensation. And that's because the U.S. tax court has been examining this area very closely for a long, long time. They have a lot of opinions published that go into great detail. And some of the other courts don't really want to recreate the wheel, so to speak. But these are some of the factors that you'd see in some of the tax court cases. The employee's qualifications, of course, is important, education and training. The nature and scope of their duties, and again, many of them do wear multiple hats, and you want to take that into account. And then amounts paid for similar services by similar businesses. Paul will be going through that in more detail later. And then prevailing economic conditions. That's a reference to the fact that you need to distinguish between, is the company growing rapidly because of the economy, or is it growing rapidly because the person running the company is doing a great job? Then the character, size, and complexity of the business, of course, is a factor. Some businesses are more complex to run than others. For example, an aerospace engineering company would probably be more difficult to run than a wholesaler. Conflicts of interest, of course, come up. And what that is a reference to the fact that the business owner may have the ability and the opportunity to adjust their own pay to unreasonable levels, either higher or lower. They might adjust their pay because they're anticipating going through a divorce, or they're anticipating bankruptcy, or their tax issues. There are a lot of different reasons why they might adjust their pay. And then intent to compensate the employee is very important too. The tax court in particular will look very closely at intent. If they believe funds were transferred from a company to an employee without the intent to compensate, then they're not going to treat it as deductible compensation by the company. And the way they measure intent is they look to see, was it included in their W-2? And if it was not, then generally speaking, if the company didn't report it as compensation, then the tax court's not going to treat it as compensation either. And then internal consistency of compensation is another factor. And that's a reference to the fact that the courts will often look to see whether there is a written methodology that's being followed year by year, or if someone's just arbitrarily setting their own pay at whatever they want it to be every year. And then covenants are important. If someone signs covenants, there may need to be some compensation paid for it to be an enforceable agreement. And if it's enforceable, it has value to the company. Of course, you and I are not in a position to determine whether something is enforceable. We may assume that it is, and that may be justification for some additional compensation. Goodwill, of course, is a big deal in business valuations, and I'm not going to try to tell you what it is because you probably know goodwill as well or better than I do, and you understand the difference between professional and enterprise. But the point that I would make here is goodwill does not just come up when a business is being sold. You commonly look at it when it's being sold and you try to determine whether goodwill is transferable. But here, I would suggest you look at it when you're determining compensation for the business owner year by year, even if the person is not leaving. You might consider yourself in this scenario. You probably feel like you have good professional goodwill in the form of your relationships, your reputation in the industry. And that's a big part of the value that you bring to your firm year by year. And so goodwill is something to consider in determining replacement compensation. And then can you confirm the facts? One of the things that the courts have asked me to do and will ask you to do as well is at least attempt to confirm the facts. If someone tells you something, for example, in an interview of the CEO, they tell you the company's growing at a certain rate, you want to look to see, do the financial statements and the tax returns confirm that? Or can you find some other way to confirm something? It can be difficult because you and I can't go back in time and observe what was really going on, but at least make some attempt to confirm the facts that you're being provided. And then this slide is really intended to be just to introduce the term comparability data. We talked about amounts paid by similar companies. The term for that is compensation comparability data. And Paul, in a few minutes, will be showing how we obtain that data and how we sort it. Okay, when we're looking at comparability data, traditionally, these are the four factors that we would use to sort the data: the title, the location, company size, years of experience, and the industry they're in. I'm going to go through each of these four in a little more detail, beginning with the title. The titles and duties are an interesting area. The fact that someone is a CEO doesn't necessarily tell you what they do. I've had two cases involving large, very successful commercial construction companies. And in one case, the CEO told me that he's all about business development. Once they get a contract in, he goes out in search of the next job. The other CEO told me that he's all about quality control. He shows up on the job site unannounced, walks the job site, he puts on the hard hat and the steel-toed boots and all that, and walks around. He inspects the material. He makes sure everything's on schedule. He makes sure there's no OSHA violations and that type of thing. So he's all about quality control. So two very successful CEOs, commercial construction companies, but they do very different things. And then, of course, a title like VP doesn't really tell you what someone does. One of the things I've noticed, too, is a lot of people are coming up with some sort of creative titles like customer experience ninja or something like that. And some of the big four accounting firms have titles that I don't really understand, like managing director or regional director, or some of those sorts of titles. We have to go beyond that to find out what somebody is really doing. So if someone's title is something like vice president, you might find that when you benchmark them, you really want to benchmark them as a CFO because that's really what they're doing. I would strongly advise you to put a note, maybe a footnote in your report that says, I'm aware that this person's title is vice president. However, I benchmark them as CFO because I believe that's most appropriate based on what they actually do. Otherwise, someone may read your report and think you just made a mistake. Location is an interesting factor. Thanks to COVID-19, I think that location is becoming much less important as we benchmark people. One of the questions have historically asked is, do we adjust based on pay scale or do we do it based on cost of living? And what I mean by that is if someone is working in Manhattan, you would presume that they're being paid more than someone who's working in Wyoming based on the cost of living. Well, that's not necessarily true. And I'll give you an example. A hospital in Atlanta might pay handsomely because it's a little expensive to live in Atlanta. But in South Georgia, where it's much less expensive, they might pay more because they have to, because it's difficult to recruit someone to a small town in South Georgia. Traditionally, the way we've looked at this is we would ask, where would the company look if they were finding a replacement? If you were replacing a receptionist, you probably would look locally. If you were replacing a CEO, you might look nationally. And so for a CEO, you might desire to use national data, conceivably. But I think that thanks to COVID-19, people are working remotely, and location is becoming less of a concern. In fact, I did a project for a technology company recently, and they told me they had a number of employees and they did not even know what country those employees lived in, which seemed odd to me, but that's the way it is these days. All right, so traditionally for an executive, you would benchmark based on the size of the company. You would consider how large it is. Certainly as a company gets bigger, you would expect the CEO to be paid more, but it does not work proportionally. In other words, if revenue goes up 10%, CEO pay does not go up by 10%. CEO pay might go up by 1%. So for executives, you might want to consider closely the size of the company. For other people, you would look more at years of experience. And to give you an illustration of that, let's say that your firm was hiring someone to do business valuations. You would presume that if someone had 6 months of experience, that they would be paid less than someone who had 6 years of experience. But really, it's not the years of experience that's important. What's important is their proficiency. You're just using years of experience to try to estimate their proficiency, and you assume that the person who has additional years is more proficient. But what you really want to know is just how good are they, how productive are they? And then industry codes is another factor that comes into play, and this is a website where you can go if you want to get a 6-digit industry code. NAICS stands for North American Industrial Classification System. Those 6-digit codes are very similar to the business activity codes that the IRS uses. You'll see those 6-digit BACs on tax returns. The SEC still uses the SIC code, Standard Industrial Classification System, which is only 4-digit. But again, industry, I think, is becoming less significant as we benchmark compensation. And to illustrate that, during my dad's career, people tended to stay in one field for their entire career. So if somebody went into manufacturing, for example, they might stay in manufacturing their whole career. Or if they went into insurance, they might stay in insurance their whole career. Nowadays, it's not that way. And you can tell that by looking at people's LinkedIn profiles. You'll see somebody worked for a CPA firm for 3 years, then they worked in the insurance industry for 2 years, then they worked in banking for 3 years. And I think some employers actually like that. They like that diversity. And so I think industry might become less of a consideration as we go forward. Also, the walls are sort of coming down. We used to traditionally have companies that either did retail or wholesale or manufacturing. Now you have more companies that are doing 2 or 3 of those. Okay, one of the sources of comparability data is publicly traded companies. The disadvantages of using this data is that publicly traded companies tend to be much larger than the companies that you and I work with. And that might be an issue. Then, of course, they also tend to be more diversified. You can tell that if you go to sec.gov and look in the EDGAR system. EDGAR stands for Electronic Data Gathering, Analysis, and Retrieval. There you can find all the information. You can find a summary compensation table where they list the 5 highest paid people. They provide their names, their titles, and then they provide the amount of compensation in various buckets or categories. But if you look at their SEC filings, you'll see that many companies have multiple SIC codes. So if a company has 12 different SIC codes on their SEC filings, that gives you a pretty good idea that they're a very diversified company, and they may be into a lot of fields that your client are not into. And then also publicly traded companies tend to have multiple layers of management. I think you knew how that works, whereas at a smaller company, you may not have as many layers. So they might not really be similar in that respect. And then also there's narrower duties. I find in with publicly traded companies, people in the marketing department really don't know what's going on somewhere else. Like in a insurance company, the people in marketing don't really know what's going on in underwriting, and the people in underwriting don't really know what's going on in claims and so forth and so on. But the information is available at sec.gov 24/7. It's available free, and you can go back as many years as you want to go back. So that is one potential source of comparability data. Other sources would be prior positions. Back in the 1990s, I testified in a case called Choate Construction Company, and one of the things that we did there was we showed that Millard Choate, prior to forming his own company, had worked for a company that he did not own. We looked at how much he was paid by that other company, and I was essentially able to use that as a floor for the amount of compensation that he would earn from his own company. In other words, I argue that he was worth at least as much to his own company as he had been to the other company, and the tax court agreed with that. And then internal comparisons also, back to my example of the granddaughter, if you have if the owner's granddaughter is doing something and you have 5 other people who have similar qualifications and similar duties, then probably the granddaughter should be paid about the same thing as the other 5 people. Other sources of compensation comparability data. BVR has some data on this that you can access. And just go to that URL right there and you can access it. And then also trade associations sometimes have some of this data. Now, with respect to the trade associations, one thing that I would caution you about is for some trade associations, not necessarily all of them, but for some of them, it can be a little expensive to join. And so the ones who do join may be the more successful, well-established companies in the industry. And so when the association surveys their members and then publishes data on how much the members are being paid, that might not be a good cross-section of the industry. You may be just getting data from the more successful companies. But trade associations do often survey their members and then publish data on how much different financial ratios such as compensation. It can be a little expensive to buy it in some cases, but your client might already be a member. And if they're a member, they might have access to it, or they might be able to get it at a lower price. This is a question that Paul and I would like to pose to you. What other sources of compensation comparability data have you used, and what did you like or not like? If you'd like to let us know afterwards. Get in touch with us and let us know your thoughts on that. We'd love to hear from you on that. And then non-related shareholders. One thing to be aware of is there's something called a business judgment rule, and courts will often say that someone's compensation must be fair market value if other unrelated shareholders agree to it. So the court will not override the judgment of those other shareholders. There was a tax court case that I testified in 2010 in which someone was paid $37 million. And the tax court agreed that that was reasonable compensation because 2 other shareholders had agreed to it. It was not cash, it was from the exercise of some options. But interestingly, the other 2 shareholders were the employees' sons, but they did not have a good relationship, so they were treated as if it was an arm's length transaction. Catch-up pay is a very big topic, and we could talk a lot about this, but very often if you're talking to a business owner, they'll often say that I'm really due some catch-up pay because when I started this company, I worked for a small amount and I maybe didn't get paid at all for a while, and I didn't get a lot of benefits. And so the company owes me some more money. Now that brings up an interesting question, and our reply might be, well, if that's true, is that liability on the books? Is it on the financial statement? If it's not, that can be a significant issue. what you might need to do is caution them. For example, Internal Revenue Code Section 409 capital A is a fairly complex section that deals with non-qualified deferred compensation. Not only is it a little bit complex, but also the penalties for non-compliance are fairly steep. Now, you probably don't want to become the tax advisor for this company, and I understand that. But to protect yourself and to protect your client, maybe what you'd want to do is send them an email and says, okay, you're telling me that you're owed some catch-up pay. Be sure you tell your tax advisor that. Also, be sure you tell your CFO that so they can get that liability on the books. And then if the financial statements have been provided to a bank, for example, you might have a little bit of an issue there. If bankers don't like to find out that they were given inaccurate information, they may not like it if they're notified that liabilities were understated by $1 million, for example. So if someone tells you they are due catch-up pay, just be aware that could be some complex tax and financial issues that have to be addressed there. And then employee benefits, typically when we are addressing normalizing compensation, we look not just at total cash compensation, but also their benefits. Sometimes you'll find business owners that don't get a lot of benefits, or maybe they have excessive benefits compared to what their peers receive. And if you want to benchmark that, you can do that at this URL. BLS stands for the Bureau of Labor Statistics, which is part of the U.S. Department of Labor. You can go there and get some data on different types of benefits. The website is a little bit cumbersome. It's not real easy to deal with, in my opinion, unless you deal with it often. But if you work with it long enough, you can get to a point where you can see how much some people in certain categories are provided in different types of benefits. So, for example, it might tell you that a certain type of person typically gets 3% of their total compensation in the form of health insurance. So you can get some benchmarking data that way. Okay, personal guarantees is another thing to be on the lookout for. It's very common in today's banking environment for lenders to require a business owner to personally guarantee a loan, even if the loan is secured by hard assets. Also, they might personally guarantee credit cards and things like office leases, copier leases, and that type of thing. That's an additional service that's being provided by that individual, and they may want some compensation for that. They might deserve some compensation for that. I always put myself in the place of that person. What if they asked me to guarantee the bank loan? I would definitely want to be compensated for taking on that risk. If you want to know how to do that, one way you can get some information is to go to a website that I've set up, which is guaranteefee.com. You can find some information there about that. But in particular, I will tell you there was a tax court case. I was not involved in it, but a case called Clary Hood, which addressed this issue. And basically it said that if someone's going to be paid a guarantee fee and the company's going to deduct it and the court is going to respect it as a guarantee fee, then the individual and the company need to come to an agreement in advance. In other words, you can't wait until after the fact and then say, oh, by the way, this person deserved a lot of pay because they guaranteed a bank loan. You've got to have an agreement up front between the individual and the company. And so if you go to guaranteefee.com, you can see more about that. But I'd be interested in knowing, and Paul would too, if you've been asked to determine a guarantee fee for someone, how you did that. You could maybe let us know later on about your experience in that area. Now, confirming an adjustment. Can you explain the adjusted return on equity or the adjusted EBITDA after you normalize compensation? I think you know that you need to do this, but for me, I just need to say it to be complete. I think that once you normalize owner compensation, that can make a significant difference to EBITDA or return on equity. And there can be a little bit of an interesting situation because if the return on equity is very, very high, then that might suggest that the owner deserves more pay. But of course, when you increase the owner's pay, that can decrease return on equity. And so just be sure that as you make an adjustment for compensation, you consider what is the adjusted return on equity and does it make sense? All right, with respect to the adjustments that you make, I also want to talk a little bit about potential collateral damage. I think this is very important. It's just something you might want to communicate with your business owner client about. Tax authorities, of course, have a very keen interest in compensation amounts because of the tax implications. So let me just give you an example. If you prepare a business valuation, and maybe you're doing it for gift tax purposes or for an estate, and you might say that this S corporation underpaid the shareholder significantly, and because you're doing this for a 709 or 706, the IRS sees your report and they might say, wow, what you're telling us is that this company significantly underreported their payroll taxes. And so just be aware that your report could come into play that way. And then disproportionate distributions, of course, can be an issue with an S corporation. If you say, for example, that someone was overpaid by an S corporation, then you're saying that some of that was classified as compensation was really a distribution, and that's a distribution to one shareholder. And if there are other shareholders who didn't get a distribution, that conceivably could jeopardize their S status. It could also violate state laws because many states have laws that say shareholders owning the same class of stock all deserve dividends at the same time. And so conceivably, you could be saying that the company violated a state law by making a distribution to one and not others. And then other shareholders, of course, are always interested in compensation. And this goes back to the comment I made earlier about engagement letters. You might prepare a business valuation report for a company, and it may be that the shareholders are all just getting along well. And you may conclude that Joe and Mary were overcompensated and everything's well. 2 years later, though, things might have changed and the other shareholders might have a falling out. And suddenly they remember that this business valuation expert said that Joe and Mary were overpaid. And all of a sudden they go and pull your report out and it becomes an exhibit in a shareholder dispute. By the way, when I began working in the reasonable comp area in 1995, almost all of the cases that I dealt with were tax cases, tax-driven. Now more of them are shareholder disputes. It's very, very common, even among family. Also, lenders, of course, as I mentioned earlier, lenders like to get financial information from companies that are borrowing from them. They go over it very carefully. They scrutinize EBITDA and different ratios. And if they find out later that someone had a distribution or a dividend and it was disguised as compensation, conceivably that could violate a debt covenant, or it could just upset the lenders because they were given inaccurate financial statements. And then prospective buyers is another consideration. Keep in mind that if someone's looking, if you're preparing a business valuation because the company is being sold, prospective buyers typically are going to sign an NDA before they're given financial information, and you hope they're going to honor it after they sign it. But I'm aware of 2 situations in which prospective buyers did not honor the NDA or perhaps didn't sign it, but they, instead of buying the business, they went back home and they called the IRS and they reported the company for having paid shareholders inappropriate amounts. And so just be aware that prospective buyers could be a little bit of a risk there. All right, and Paul, I'll let you take it from here for a little while.
Fantastic. Thank you, Stephen. Give me 1 second to get things set up on my end here. Thank you very much, Stephen, for walking us through the first half of our time together. The second half of our time together, we're going to get a little bit more in depth on the different approaches for determining reasonable compensation, and talk about a few of the different methods that are out there. In the field of reasonable compensation over the last decade and a half, it has really come a very long ways. For a long time, reasonable compensation was pretty ambiguous. A lot of reasonable compensation figures were pulled out of thin air, where you started with some basic facts and made a big leap from some basic facts to what reasonable compensation should be. But today we have much better information and guidance on reasonable compensation and some of the different approaches and methods to determine that. And one of the big pieces of information that came out to help with that was a reasonable compensation job aid put out by the IRS. It's an internal job aid that was put out in 2014 and made available for or to the public a year or so later. A couple of things to keep in mind about the job aid is that it was put together by the Large Business and International Division. And I point that out because it definitely leans toward that. It leans toward companies that are quite large, the type of companies that Stephen was talking about that you might go in and find in the Edgar system. And because of that, a lot of the information kind of leans that direction. And when you start to look at the different approaches and where and when they use them, it fits really well for those large businesses, but some of that information doesn't fit as well for what we're going to be mainly talking about today. And I suspect what most of you think about as far as your clientele and the clients you work with, and you think about closely held businesses, which are those small or medium-sized closely held businesses. It discusses 3 different approaches for determining reasonable compensation. Stephen touched on those a little bit earlier, and I'll go through those in more in-depth here in just a minute. It does point out that companies have the burden of showing that compensation is reasonable. It's not the IRS's job to figure out whether compensation is reasonable or not. It's the business's responsibility to show that the compensation being paid is reasonable. Generally, what that means is you need to have some kind of credible process or documentation, something in hand to back up that conclusion. A lot of you out there probably know Michael Gregory, and I've gotten to know Mike and Stephen quite well over the last decade. The world of reasonable compensation is quite small, and Stephen and Mike are at the top of that profession. But one of the things we need to thank Mike Gregory for is having this job aid released to the public. He is the person that filed the Freedom of Information Act so that we have that job aid available to us. It's simple to find. If you do a quick Google search, you'll find it. And then Mike has put together a number of books since he's retired from the IRS. And he has one on business valuations in the IRS. He has an entire section in there just on reasonable compensation. This is a great reference resource. If you don't have a copy of it, you might want to consider grabbing one. Let's talk a little bit about the different approaches in the IRS job aid. And one of the things that the IRS job aid does very, very well is it explains the different approaches in a way that most advisors will remember them. And I like to explain them the same way. And the way they do that is they compare the different approaches for determining reasonable compensation to the different approaches of a real estate appraiser would use to value real estate. So taking a page out of that job aid, first approach we're going to look at is the cost approach. And so if you're a real estate appraiser, the cost approach is very similar to how you would price out the cost of a new home. Where you would start with a set of blueprints, you'd do takeoffs with all the materials and labor that's needed, you'd add it all up together, and you would come up with a cost to build that home. The cost approach is also referred to as or known as the many hats approach. And the cost approach for determining reasonable compensation is very similar. It takes into consideration all the different tasks performed by the business owner, such as administration, accounting, marketing, purchasing, etc. And it breaks the time spent by the owner down into the various tasks that are performed, and then wage levels are assigned for each task based on the owner's proficiency or skill level. They're added up together to obtain a hypothetical replacement cost for the owner using comparability data. Stephen talked quite a bit about comparability data. It is the gold standard on how you determine reasonable compensation now. So the comparability data you're typically looking for when you're using the cost approach is what's referred to as cross-industry data. For a couple of reasons. When you're looking at a small business owner or any business owner that's wearing multiple hats, they may be wearing hats from different industries. In addition, the cross-industry wage database is also one of the most complete and largest sets out there. So it is generally the data set you'll be looking for when you're using the cost approach. So when would the cost approach most make sense to use? Well, the cost approach is generally used for what we think of as micro or small businesses, where the owner's wearing multiple hats. And I think a lot of us can relate to that in either our own businesses or in other businesses that we've evaluated. So I do want to just mention a quick word of caution on the cost approach, and this is mentioned in the job aid. So a minute ago, when I mentioned that the job aid was put together by this Large Business International division, the cost approach does not have a big following or a lot of respect from the valuation community traditionally. It has gained a tremendous amount of respect, and a lot more evaluators are using it than they used to. But some of the reasons why can be linked back to the job aid is because some of the cautions that were in there on using the cost approach. Well, the cost approach doesn't make a lot of sense for really large businesses, because when you're looking at the executives in there, they're not wearing multiple hats. But the way the cost approach was being misused, and this is pointed out in the job aid, is really large companies are typically looking to try and increase or fatten up their reasonable compensation. So they were stacking job duties or stacking hats one on top of another. So they were paying themselves a annual wage for marketing, an annual wage for training, an annual wage for management, and they were stacking those all one on top of each other. So let's say each of those paid $100,000 a year, they would set their salary at $300,000. And so when you're talking about the cost approach, you're talking about blending, not stacking those compensation figures together. And when I walk through a case study here in a little bit, that'll demonstrate what I'm talking about a little bit clearer. So the next approach I'd like to talk about, and this is a favorite for most evaluators, is the market approach. If we put our real estate appraiser hat back on, this is how a real estate appraiser would likely appraise homes in a tract neighborhood or in a condo complex, as Stephen mentioned, where the neighborhoods are all quite different, but the homes in them are very similar. Real estate appraiser would have a subject property. They'd go into the same neighborhood as that subject property. They'd try to find other homes that have sold recently, and they'd make some adjustments up or down based on square footage, finishes, that type of thing. And so the market approach is also referred to, or also known as, the industry comparison approach. And the market approach for determining reasonable compensation is very similar. It determines the owner's compensation by looking at compensation of employees in businesses of similar size and from the same industry. That's our same neighborhood, so to speak. The market approach focuses strongly on the owner's business and the specific position being held. Typically, that's going to be either a management or executive level position, and there's a real practical reason why I'll share with you here in just a minute. The approach then compares both the business and the position of the owner to its peers, and it draws a conclusion for what reasonable compensation should be, again, using comparability data. So in the market approach, the comparability data that we're typically looking for or relying on is called industry-specific wage data. Makes sense. So when would you typically use the market approach when we're, again, talking about closely held businesses? For what we tend to think about as medium-sized businesses, and these are businesses that have typically grown up over time. In the early years, the owner may have been wearing multiple hats, but now that the business has grown and matured, the owner has now either predominantly or exclusively moved into a position of management or at executive level. If that's the case, then the market approach would likely be the approach you'd want to use for that owner. Real practical reason why you would use the market approach mainly for management and executive level positions is because industry specific wage data that is gathered in quantities large enough to be credible and defendable is incredibly rare. There's not a lot of it out there that's produced in credible amounts. But a few of the areas where it is produced in very credible amounts is in those management and executive level positions. The third approach outlined in the job aid is the income approach. And for this approach, we're back to being a real estate appraiser. We're now appraising commercial real estate, where an investor or a buyer might be interested in what the market or cost approaches would be for determining value on that property. But what are investors typically interested in? How much money am I going to make if I buy that building? What's my return on investment going to be? The income approach is also known as the independent investors test. And the approach for determining reasonable compensation using the income approach follows that same thought pattern, but it does vary from the cost in the market in one very, very big way. And that is the income approach does not rely at all on comparability data. Instead, it seeks to determine whether a hypothetical investor would be satisfied with their return on investment when looking at the financial performance of the business in conjunction with the compensation level of the owner. And the income approach is based on a very simple formula put out by the IRS, and we'll talk a little bit more about that here in a few minutes. So when would you typically use the income approach? Well, most of the time in either compliance or in valuation settings, you're going to use the cost or the market approach. But the income approach really isn't used as a primary approach very often. Most of the time, the income approach is used for what we think about as outliers. And outliers are simply people that have a very unique occupation or skill, so much so that we don't have comparability data. And if we don't have comparability data, we can't use the cost or the market. So we can fall back on the income approach. Outliers are also folks that are sometimes referred to as key or superior employees. These are folks that may have a common occupation, but their results are so far and above their peers that the comparability data doesn't apply. Again, they'd be considered an outlier. You can fall back here on the income approach. More often than not, when you see the income approach used, especially in litigation and valuation, it's used as a second opinion or test to back up a primary conclusion, such as the market approach. It can also be used as a tool, if you are in litigation, to test the other side's reasonable compensation figure and see if there is possibly an opening to challenge that figure, depending on how you're working with or supporting a litigation partner. So let's take those three approaches, and let's walk through a case study. We're doing a case study today of Johnston Signature Homes. This is based on a actual valuation and litigation case, but I've changed enough of the information in here to protect the guilty. So Johnston Signature Homes is a custom home builder in the Denver metro area. And they specialize in building custom homes that sell for somewhere in the neighborhood of $1.5 million to $3 million each. And they build them in old areas of Denver, where original homes were built in the 20s, 30s, and 40s. They were quite small, but on very nice size lots. And companies will come in and buy those lots and do what we call scrape, where they scrape the old home off. Takes about a day or two, and then they'll build construction, start construction on a brand new home. And that's the market that Johnston Signatures Homes is in. And they will generally complete somewhere in the neighborhood of 18 to 24 homes per year. Johnston Signature Homes is owned by Mike Johnston. Mike started Johnston Signature Homes about 20 years ago. He has a degree in architecture, so he came out of college. He worked for an architecture firm for a number of years, then moved on to a design build firm that specialized in high-end custom homes, worked for them for a number of years. And then about 20 years ago, he went out on his own and he formed Johnston Signature Homes. He also employs both his daughter, Kim, and his son, Brian. Mike, if you go to their website, is listed as CEO. His son and daughter are both listed as vice presidents. Annual gross revenue, $50 million, and they employ about 35 people. So as part of this valuation and litigation, because Mike is getting a divorce, we need to step in and we need to normalize not only Mike's compensation, but the related parties. We need to normalize both Kim's and Brian's as well. So we're going to start off with some of the advice that Stephen shared with us. We're going to interview Mike. We're going to learn what we need to learn to help us normalize his owner's compensation and find appropriate comparability data. So a few of the things that Mike is responsible for: overall management of the company. He participates in key supplier and vendor negotiations. He is responsible for some of the relationship management with certain realtors and bankers, closing certain clients. If you're about to drop $3 million on a custom home, you might want to meet the owner of that company. Works quite a few hours, 50 to 55 a week. He does personally guarantee some debt and speaks fluent Spanish, and that is a big asset, especially here in the Denver market, working with subs and subcontracting companies. So looking at that fact pattern, but let's take a step back and take a quick look at both Kim and Brian's interviews, a little bit more about them first. Kim was listed as vice president. That doesn't tell us a lot. So when we interview Kim and find out what she really spends her time on, she spends a little bit of time on both bookkeeping and payroll. She does have accountants helping out with that, but she is responsible for it and spends a little bit of time on it herself. She spends some time in HR, helping administer benefits, work comp, unemployment, those types of things. But she spends most of her time in sales, both directly working with clients and also overseeing the other sales associates that work for Johnston Signature Homes, either directly selling the homes or working in the showroom, where you would pick out, your countertops, sinks, finishes, that type of thing. And Kim works a lot of hours. She works 60 plus hours per week. And last, let's take a quick look at our interview with Brian, also listed as vice president. But what does he really do? He implements his father's strategy and direction. Brian spends a lot more time out in the field. So he oversees employees and subcontractors out in the field. He'll fill in for key employees when they're out, such as superintendents or foremen. does a lot of training of the employees, and works about 40 to 50 hours per week. So once we have gathered this information, then we can think a little bit about what approaches will work best for Mike, Brian, and Kim. So let's start off with Mike. So here's what we know about Mike on the left: management, overall management of the company, supplier negotiations, relationship management. But he's working at a very high level, right? At an executive or CEO level. And so what that's telling us is that we want to look at the market approach for Mike. So let's go ahead and take a look at how we would determine Mike's reasonable compensation using the market approach within RCReports. All of our interviews start with a purpose. Why are we running this report? And we are running this report to normalize compensation for valuation. Those of you that run blended practices, we have other reports for compliance for S&C Corps. We also have a planning report, but for today, the only report we're going to be looking at is for normalizing comp for valuation. Once you've selected the purpose, then you need to select the approach, and you can select from one of the three approaches we already talked about that the IRS Job Aid talks about as well. For Mike, the market approach fits best. Once you've selected that, then we need to figure out where he fits best in the description. Stephen talked a little bit about this as well. You have a lot of titles out there, but the titles aren't always helpful. What you really want to do is look at the description. So when you look at through the description of CEO or General and Operations Manager, a couple of the options here available. Chief Executive fits really well for Mike, so we're going to select that. And then we're going to add some other basic criteria of his company and its location, the Denver metro area of Colorado, and his industry. And then next is some basic business criteria. Easy enough to get the first couple of answers on here, which are number of employees and adjusted gross profit. Also at the bottom, time dedicated to the business. We have some different brackets in there. He would fall into that overtime bracket at that 50 to 55 hours per week. But in the middle there, we have business performance versus peers and owner's experience and proficiency level, again, versus peers. This is where some of the subjectivity and professional judgment come in, and why some of the questions you ask when you're interviewing your client can help. So when we look at Johnston Signature Homes against other competitors, other home builders doing the same thing, how does that company rate? And we've looked at that, and we've made the judgment call that it is average against those other companies. But when we look at Mike as CEO of Johnston Signature Homes, where would he fall? And we looked at it after interviewing and getting to know Mike as high for a number of reasons. One, he's been in the industry for a long time. He's very well respected. He belongs to a number of organizations. He served as president of the Builders Exchange and worked with a number of the tech schools and other schools and trade schools in and around the Denver area. So we have some reasons and some foundations for moving him up on that skill level or proficiency scale. Once we have that information in, you saw at the bottom of the screen some different ranges based on location. So we have a local, a state, and national ranges and suggested wages. For Mike, we are suggesting a figure of $276,000, but based on some other things you know about Mike and where he might fall in those ranges, you may suggest a different number, or depending on the situation with your client, you may be looking at national or state numbers as well. What's included in that number from RCReports is taxable Medicare wages and bonuses, as well as healthcare and flexible spending accounts. It does not include some of the softer benefits such as company loans, vehicle allowances, and other items not reported on a W-2 as taxable compensation. you are looking at the first 2 pages of what is typically a 4 to 6 page report. These reports are built to defend compensation, the compensation amount, and are also built to go into litigation and or to an examination. The first page, second page have a lot of the information that most of the time is looked at first in litigation or examination. But the supplemental pages, if you want to see those, there's a handout for those. But it includes key court cases and other considerations. Basically, everything in this document is there to defend the reasonable compensation figure that we've come up with. Let's move on to normalizing Kim's reasonable compensation. Kim wears multiple hats. We've set her up as a good candidate for the cost approach because of the multiple hats she's wearing. So let's go ahead and take a look at how that cost approach works. Again, we need to first select why we're running the report for valuation, normalizing compensation. This time we're going to select the cost approach because it fits best for Kim in her situation. Why are we running or what year are we running the report for, and a couple other options in here. I'm kind of running through some of the screenshots here at a pretty high level, kind of a 10,000 foot level. Adam from BVR is on here today. He and his team are very, very well trained in our software. So if you are considering you'd like to learn more about it, just reach out to Adam or somebody on his team, and they can definitely drill down into the software more than I am today. Once we've selected the approach, we can decide how we want to get the answers to the interview done. Because the cost approach is significantly more robust and asks a lot more questions than the market or the income. We have a couple of ways to gather that. You can send an interview to Kim. She can fill it out and send it back to you. You could also fill it out on your own. We've gathered the information from Kim already. If you've done that, it'll take you about 5 minutes or so to input that information. If Kim is doing it on her own, it'll probably take her maybe 15, 20 minutes. We have 8 steps. You'll see them outlined at the top. And the first thing we need to know is where are we pulling the comparability data from? Well, Denver, Colorado. So we've got Colorado and Denver. And then after that, we need to know how much time is Kim dedicating to the business. She works a lot of hours. So we have her up at 60. There is an industry standard of 40 hours per week. A lot of times we will recommend you don't exceed that. In this scenario, it makes sense to exceed that. So we've taken Kim up to 60 hours a week. We're in a section now called standard tasks. You'll see that in the upper left. And then you'll see 8 categories on the left that most small business owners will perform tasks in, or different hats they would wear, maintenance, administration, all the way down through management. For Kim, what do we know about the different hats she's wearing? Well, under advertising, sales, and marketing, we have sales representative. Under accounting, financing, and bookkeeping, we have both bookkeeper and payroll and time clerk. This is where descriptions come in very helpful. Under human resources, human resource clerk actually fits very well. Really what she's doing is a lot of the record keeping on the employees. And then finally is management. This is our most robust category. And because not only does Kim sell, she also oversees the different sales folks. We have sales manager in here. In addition to standard tasks, we have another section called My Business. For Kim, we're not going to use that today. We've accounted for all the hats she's wearing. But in another scenario, if you were doing this for, let's say, a plumber, you could come in here and you could select plumber and add that task in here as well. And there's, I think, somewhere in the neighborhood of 6,500 to 7,000 different titles and job tasks to choose from in this section. Once we have all the hats selected for Kim, then we just need to apportion that time out. And so we've done that here on this screen. We've accounted for 100% of her time. And then we have one step left. And in this last step, there's a couple of things we need to do, but one of them is find out where Kim fits in that skill level or proficiency. And again, I like to use skill level and proficiency, not necessarily experience, because you can have 20 years of bad experience, or you can have 3 years of really, really good experience. My suggestion here is start at average and then go up or down if you have a reason to. So Stephen mentioned somebody in the medical field who had lost their license. That might be a good reason to go down on the scale. For Kim, on sales representative, she does a very, very good job and is very well respected as a sales representative selling directly. So we have that above average. Although she doesn't do all of the bookkeeping and payroll, because she has help on that, she spends some time on it, but would be considered average. HR is not an area she enjoys doing or is particularly good at, but it does fall into her bucket of duties, so we have her at below average. And then she's very, very good and very well respected as a sales manager in running both the showroom sales folks as well as the folks that are going out and selling directly or selling the whole homes directly. Once we've finished setting the skill level or proficiency, we finished up that interview, and we'll get a reasonable compensation figure using the cost approach for Kim. In this scenario, we're going to come up with about $157,000 to replace Kim in her company using comparability data. And in Mike's scenario, we used industry-specific wage data. In Kim's, we're using cross-industry data. Second page of our report, especially in the cost approach, is the one that it's typically the one in either litigation or examination that is used quite a bit because it shows exactly how the reasonable compensation figure was reached. There's no ambiguity, there's no guessing. It shows exactly piece by piece how that reasonable compensation figure was built. Last, let's talk about Brian. So Brian's also listed as vice president, but when we look at what Brian actually does for Johnston Signature Homes, when you look at it, it's not real clear whether the market approach or the cost approach would fit best. If you look at the definition for GM, for instance, plan, direct, and coordinate operations of a public or private company. Responsibilities include formulating policies, managing daily operations, funding the use of materials and human resources, maybe not classified in any one functional area, etc. Well, that fits what we know about what Brian does. So we could use the market approach and use general or operation manager. We could also consider the cost approach, the different hats that Brian is wearing, right? Superintendent, training, management, interviewing and hiring for the company. So in this scenario, since it's not as clear cut, I would likely run both approaches and see where they come out. So for Brian, if I were to run the cost approach based on some of the information we just looked at, we'd come out at about $171,000. If we run a market approach, we're going to come out at about $158,000. And after looking at both of these, I would likely use them both, and I would weight them and reconcile them. And because I think they're both good options, I would probably weight them both about 50-50, and I would probably recommend a reasonable compensation figure for Brian, probably in the neighborhood of maybe $165,000, $166,000. So a little earlier, I did a rundown of the interview with Mike and all the things we would want to know about his compensation. Well, there's a few things that we didn't take into consideration. Some of you may have caught that, and if not, what we didn't take into consideration was he personally guarantees some debt and speaks fluent Spanish. And the reason we didn't take it into consideration already is because comparability data just doesn't include that level of detail or that level of information. So this is where we need to take a little bit of a step back and use our professional judgment or some additional tools like the tool Stephen now has available for personal guarantees of debt. And so at RCReports, we handle that through what we call an advisor worksheet. So for Mike, what we want to do is make some adjustments to the reasonable compensation figure that RCReports generated. There's a couple of ways you can do this. Along the top, you'll see the ranges at the local, state, and national level. There's a little green check mark next to 276. That's the number I'm going to start with. Since I've selected that, and then I have done some research, and the personal guarantee of debt for Mike, we're going to add $30,000 to his annual salary, as well as under unique requirements and skills, $10,000. There's some other categories under here that you can roll over the Learn More button that can help you decide if you need to make some other adjustments up or down. But we come up with an adjusted reasonable compensation figure for Mike now of about $316,000. And another way that you can accomplish the same thing in the RCReports software is you can select a different starting number. So now we've selected 319 as our starting number, and instead of making the manual adjustments, we've just made some notes as to why we're adjusting that number from 276 to 319. We'll save those notes, and then you can save this worksheet as a PDF, and you can attach it as an addendum to the reasonable compensation report. So here's what those two different worksheets would look like. And again, they're coming out pretty close to one another, one at 316 and one at 319. So we would likely recommend Mike's reasonable compensation, probably somewhere in the 315 to 320 range. Because this valuation and normalizing reasonable compensation is in litigation, reasonable compensation amount is one of the highly contested issues in this case. So because of that, what we want to do is take a step back and now run the independent investors test on Mike and see how our primary conclusion with the market approach fits in to that independent investors test. So if you've ever heard simple isn't easy, the income approach fits that definition very well. You only need three pieces of information. You need the fair market value of the company at the beginning of the year, its increase over that year, and what that independent investor would be looking for as a return on investment. If you have those three pieces of information or can reasonably estimate them, it's easy enough to get a income approach reasonable compensation figure. Again, once you've put those three pieces of information in, RCReports will do the calculations for you. In this scenario, we come up with about $245,000 as Mike's reasonable compensation. That's a little bit lower than the 315 to 320 that we're coming up with, so we need to be aware of that and have some reasons as to why that might be lower. But we may have also overshot what an independent investor would be looking for, because Mike's company has been around for 20 years. It's very stable. A 10% rate of return might be more along those lines. And you can see some ranges on the bottom of your screen right now, but if you were to scroll over to the left at 10%, you're actually going to hit right in that 315 to 320 area. And if that return on investment of 10% is the most accurate number, now you have supported your primary approach market with another approach, which is the independent investors test. And you can put all that information into RCReports and again generate a reasonable compensation report using the income approach. A little bit of background on RCReports and why we have an excellent track record in both examination and in litigation. It's because our foundational data is very, very stable. It's very well collected, scientifically collected in amounts that are credible. And we have an entire group, and we'll talk a little bit more about who heads that group up here in a minute, that is dedicated to producing our wage data sets. And so all the wage data sets that we publish and put out there have been through a rigorous process and produce confidence levels in the 90 to 95% range. We produce a very thorough methodology report. If you're heading into litigation or even to examination, have this resource available for you. You can get a copy from BVR. You can also contact us. We can get you a copy of it. For each year's data sets, we also do an internal data report. And all of this is overseen by Bill Schneider, who's our VP of Analytics, VP of Data. Going into litigation in court, 100% of the time, the methodology report has given our standard reports all the additional credibility they need, and they've been accepted in. But in any instances where that's not the case, we can certainly put anybody who's having other issues getting those reports in touch with Bill Schneider. But in a decade, like I said, the methodology report covers everything that is generally in question or questioned about our reports and our methodology. I'm going to switch gears here just a little bit. We're going to talk a little bit more about professional judgment, and I'll start looping Stephen in here a little bit more as well. But some of the adjustments that you may want to make to comparability data, I've already talked about, and so has Stephen. But just to recap, internal consistency, past salary history, and personal guarantees of debt are a few of them, followed by key relationships and contracts, being multilingual. And one we haven't really talked about, and I'll see if Stephen has any thoughts on this as well. When I have reconciliation on there, I'm not trying to get the people getting divorced back together. What I'm talking about is you may want to use data from multiple sources, right? So you may want to use RMA and RCReports and an industry data survey. And look at those and decide their credibility and then weight them appropriately. And that may be another way that you decide to make an adjustment. Stephen, did you have any thoughts on some of the adjustments?
Yeah, I think you're exactly right about using multiple sources. If you want to do that, you can weigh them and evaluate them. And if one is better than the other, explain that. Also, reconciliation brings to mind the differences that you might get from your sources of data. We talked about interviews, for example. You might interview two people and they give you two different stories, especially in divorce. And you might have to reconcile the facts between the two interviews, or the tax return might agree to what someone tells you. Those are the types of things that any court is going to expect us to explain in our report, to say we recognize there's a difference here, and then address that. If we're going to go with one set of facts as opposed to another, then we need to say why. And so that's the word reconciliation could apply to the sources of data that you're drawing from as well.
Good call out. That makes perfect sense and something to keep in mind. We're also going to move more into Stephen's wheelhouse with expert witnessing. Stephen has sat on both sides of the aisle, working for both, I believe, the IRS in certain scenarios and for private companies, obviously. But one of the things Stephen's taught me and talked a little bit about is different courts tend to lean to or focus in on different schools of thought when it comes to reasonable compensation.
Yeah, and I'd like to point out that when you're preparing a business valuation, typically you will mention the most accepted methodologies, and you'll explain that you're only using one and explain why you're using that one, or you'll weight them differently. The same can be true when you're making an adjustment for compensation. When you prepare a report, you never know whether it's going to court or not. You never know what the court might do with it. And so it might be a good idea to use the multi-factor approach and the investor's test, perhaps to confirm your conclusion from the multi-factor approach. But if you use the different ones, then the court won't criticize you by saying you did not address why you didn't use the different methods, or they won't say you didn't consider them. Generally speaking, if something's not mentioned in your report, a court is going to say you did not consider it. You may have considered it, you just didn't put it in your report. So it's a good idea to at least mention it briefly, to say, we considered these different approaches, we chose to use this one, and this is why. And then with the multi-factor approach, Paul, obviously there are a number of cases, some of them go way back in time, where the courts, and these are tax court cases that have addressed the multi-factor approach. The Brewer Quality Homes case is a very interesting one. It's a lengthy opinion, but it's well worth reading. It covers a lot of ground. There was a personal guarantee there, and the IRS suggested that an individual deserved $5,000 for providing a personal guarantee. That was sort of random, but nobody else seemed to challenge that, so the court went with it. They also addressed the intent to compensate in that case. That was a pretty big issue there. And there was some compensation data introduced from RMA, and the court said that the RMA ratios leave much to be desired. That's their word, leave much to be desired. But they ended up going with it because they said there was, their wording was, in the absence of anything better. So in other words, the RMA data, they said, was not helpful in terms of benchmarking compensation because there wasn't enough information provided. Now, RMA might be very, very helpful if you're doing something else, if you're benchmarking debt to equity ratio or something like that. But at least in that particular instance, they said it was not very helpful in benchmarking compensation. And then the independent investors test is a newer approach that comes up in some of these court cases. Exacto spring case is a situation that's mentioned fairly often. In the Exacto case, the court said that the independent investor test was appropriate because using the factors invited the tax court to set itself up as a personnel department. So they felt like the independent investors test was more appropriate. But in that case, in Exacto spring, the individual had developed a new product and he had marketed it, so he was very, very valuable to that particular company. The Midwest Eye Center is also a very interesting case. One of the lessons to be learned from that one is that if you're going to take a position, you better explain why. In that particular case, there was an ophthalmologist who did more surgeries than he had done previously because one of the other eye surgeons had left the practice. And he said it deserved a larger bonus, but there was no reconciliation between the number of surgeries and the amount of the bonus. And the court was very critical of that. In Aries Communications is another case that's a little bit unique. In that case, an individual negotiated higher prices for sales of some FCC licenses in California. And the court concluded that he had negotiated an additional $2 million in sales price, and his bonus would be 1/3 of that, which seemed a little bit random, but they did that in the absence of anything better. So these court cases, I think, are very interesting to read. It's kind of like each one's a little John Grisham novel, but it gives you an opportunity to look behind the curtain at how these businesses operate and also see how different expert witnesses approach their methodologies and where they got their data. But in a report like that, also be very, very careful about the difference between facts, assumptions, and opinions. If you're providing facts, you might say where they came from. Maybe the facts came from a financial statement or tax return. If you give assumptions, and I know you do in your report, you explain assumptions, you might want to say why you assumed what you did. Maybe it's just an assumption you make in every report, or maybe it's an assumption you were provided by an attorney that hired you. And then in your opinions, you need to provide a basis for your opinions.
And Stephen, I jumped over label graphics. I'm not sure if you had any commentary on that.
Yeah, label graphics is another interesting case. They chose to use 5 factors from the Elliott's case. Elliott's is another tax court case that's often cited. That was a case that was appealed to the Ninth Circuit. Another one you might want to read. And then the IRS fact sheet also provides a couple of important statements. It says, at least with respect to the IRS, that an officer of a company is considered to be an employee. However, in an S Corp, it says reasonable compensation will not exceed the amount of money going to that individual. So in a startup situation where the company cannot afford to pay a shareholder, and there's no transfer of funds from the corporation to the individual, then reasonable compensation could be 0. So in working with S corporations, just keep that in mind. You might want to pull that IRS fact sheet down. It's publicly available, and take a look at it. It's not very long. You can easily read it.
Again, in Stephen's wheelhouse is being prepared should you end up as an expert witness and or get pulled in there, even if you weren't planning on doing that, making sure that you can get through a Daubert challenge. To my knowledge, every single case that RC Reports has been involved in, we've moved through that piece without any issues, generally with the full methodology report attached. Some other sources of data and know the methodologies. Stephen talked a little bit about RMA data. I'll touch on some other sources of data such as ERI and MGMA in a couple of minutes. But Stephen, what are some of the things you consider when you're preparing for depositions or court?
Well, in court cases, it's very, very common for opposing counsel to file what's called a motion to exclude. And that's where they're basically asking the court to kick your report out, not even consider it. And I've had a number of motions to exclude filed against me. None of them have been successful, fortunately, and I hope I can keep that string going. But in these Daubert challenges, the 2 things that you see on the screen are the ones that are normally attacked. Opposing counsel will challenge the source of data that you used and your methodologies. Those are the 2 things that they can use potentially to get your report excluded. They're not going to file a motion to exclude and just say, we disagree with you. They're going to attack your sources of data or your methodologies. Those are the 2 common things they'll bring up. So be sure you use commonly accepted methodologies.
I bring up this quote because this is one of my favorite quotes from a S Corp case called McAlry in 2013. There is a lot of subjectivity in the field of reasonable compensation, but that's why it's very helpful to have a roadmap or to have documented your conclusions. So you can show folks or show opposing counsel, examiners, whoever might be interested in that conclusion, how you got there. But there is quite a bit of subjectivity in the field, which is why this is a field that is left to the professionals like yourselves, and professional judgment comes in a number of places in that. And I think both Stephen and I touched on that quite a bit today. This is my favorite Stephen slide, so I'm just going to let him take it from here.
Managing your ego is, of course, very important when you're working on these cases. You want to be sure that your ego doesn't get out of check and that you avoid personal judgments. The issue of personal judgments, I think, is a very important one these days. A lot of people do have biases. And just keep in mind that when you're preparing a report or you're an expert witness, you have to be unbiased, very objective. Sometimes that can be difficult. But people have strong feelings these days. People have strong feelings about the economy or about politics, about spiritual issues, about DEI, about race, about firearms. It can be very difficult for you to convince a judge or a jury that your work is objective if it involves a firearms dealer, for example, if you have posted comments on social media about gun control. I just give that as an example. We live in a culture today, you hear the term cancel culture. Many people have strong feelings on some of these issues, and we have to keep that out. We can be an advocate for our opinion in a matter such as how much someone's replacement compensation should be, but we're not to be an advocate for our political issues or our or spiritual issues or whatever it might be. So those types of biases, I think, become very, very important. If you're going to testify in court, you can expect opposing counsel to look at your social media and see what you've posted, and they will bring that up, and they'll ask you about it. So just be very careful about that and be sure that you're prepared to be unbiased in your work and in your testimony.
Another call out on ego. I know that Stephen mentioned to keep your own in check. That's never an issue with Stephen. And I thought this story came from Stephen, but maybe not. But it's just a quick story about a business owner who was having their compensation normalized. It was a fairly good-sized company, what we think of as a mid-sized company. And that reasonable compensation figure came out to somewhere in the neighborhood of $450,000. And the owner was a woman, and she was upset at that number. She'd given so many years of her life to the business. She was a workaholic, and she thought she deserved pay significantly higher than that, up at right around 7 figures. And so the comp expert in that scenario had to manage the ego a little bit. And he did it this way, and I thought it was genius. He said, look, if we set your reasonable compensation to $1 million a year, will you be happy? And she said, yes. And he said, well, I've looked at all the things that you do for this company, and I'm well qualified to step into your shoes if you need to step out of the company for an extended period of time or a sabbatical. So when I step in, I'll get paid that $1 million as well. And at that point in time, it made sense, and the light bulb went off, and she immediately understood that $450,000 number, that's the replacement cost, right? That's the normalized adjustment, right? She may get the other $550 in distributions or in dividends, but that was a good way of managing ego in that scenario.
Yeah, I think that sort of replacement situation is a good illustration. As I mentioned earlier, when I'm looking at a personal guarantee, I ask myself, how much would I want to be paid if I was guaranteeing the company's debt? When you look at it that way, it gives you a very different perspective.
Yeah, absolutely. And a couple of final thoughts on reasonable compensation. I'm surprised Stephen hasn't put a book together. He certainly has the experience and knowledge, but there are a couple of books out there. You can get them through BVR. First one has been out a little while. I don't think they've done a second edition of it by Ron Sr. and Kevin Yiannopoulos. This came out a year or two before RCReports was launched. So we are not mentioned in there, but Ron Sr. Does use RCReports in his practice. And then I mentioned this a little earlier, by the book for Mike Gregory. He has a number of different books out, but this one is quite thorough on business valuation. He has a whole section dedicated in there to reasonable compensation, and a couple of call outs from that book that I wanted to make when you start to consider sources of data and being prepared for going into litigation and knowing the sources of those data. And so some of the more common ones we've already touched on. Stephen talked a little bit about RMA, but there's a few things that Mike calls out that are worth mentioning. And first is documentation. Documenting all the required elements by a compensation expert adds real credibility and analysis and can save a lot of time and expense later. If you're normalizing owner's compensation for your valuations by pulling a number from your professional judgment without having any backup, that may be fine in the immediate or in the moment, but down the road, if that valuation comes back up and ends up in a shareholder dispute or some other type of litigation, that number is very vulnerable. Understand the sources and quality and shortfalls of the data sets you're using. It doesn't mean you shouldn't use them, but you should definitely understand what their pluses and minuses are. So some of the more common ones that I see used outside of RCReports are ERI, and Mike has a number of cautions on using ERI data. Check out his book on some of that, or contact me afterward and I'll share that with you. But one quote out of the book is, do not use the RS software only to determine reasonable compensation. It can be used a lot to see if there's an issue or develop an issue, or kind of benchmark and see if it falls out of that. But he does not recommend using it to actually determine reasonable compensation. And another one is MGMA. Kevin Yiannopoulos, who co-authored the book with Ron Sr., talks a little bit about a court case called Ackerman, and sometimes industry standard data, the way it's collected, if you either don't understand it or it's not collected in a way that really gives you that comparability data, you can find yourself with a conclusion that's not going to withstand scrutiny, and that's what happened in that Ackerman case. And then last is, just don't blindly rely on the compensation surveys that are out there, and that's where I was talking a little bit about MGMA. Understand how they gather the data, what questions they ask, and what's actually in that number. And with that, I would just like to take a short moment to thank Stephen for joining me today, and take a little bit of time and answer some questions or share some other stories from the world of reasonable compensation and expert witnessing. Stephen has a whole treasure trove full. If you ever get an opportunity to catch up with Stephen at one of the live conferences or events that are now back in style, I'd highly recommend that you do so.
Thank you, Paul. And if you want to take a look at the questions, there's one that looks like it's for you, and there's a couple that I'll answer.
Yeah.
One of them says, for valuations of non-controlling interests, do you still consider owners' compensation adjustments, even if the non-controlling owner can't change compensation? I think the answer to that is yes, you still consider a potential adjustment. But in that scenario, it may be that there's no adjustment necessary, because if someone's not a controlling owner, they're not related to whoever has control, then most likely their compensation has already been negotiated at arm's length, and there may be no adjustment necessary. And then also there's a question about why aren't guarantees part of the owner's role versus the employee's role. Some of that comes down to what the banks require. Very often a bank will require the guarantee of someone who is on site in the business, actually in control of the assets. They're not so concerned about a shareholder who maybe lives remotely and is not active in the business. They want a guarantee from somebody who's actually there, hands-on, controlling the inventory or controlling the process. So it comes down to whatever the bank or the lender is asking for. But the situation is the same. It may be the owner's role, it may be the shareholder's role to guarantee the debt and not an officer's role. But nonetheless, even if it is a shareholder role, the shareholder still may deserve some compensation. You can imagine if three of us owned a firm together, and you were asked to guarantee the debt and the other two owners were not asked to guarantee it, you'd probably come back and say, hey, wait a minute, we each own 1/3. If I'm going to be the only one taking this risk, then I want to get some compensation. So I think a guarantee fee can be appropriate regardless of whether it's paid to someone in the role as an owner or in the role as an officer, because really what you're paying them for is not for being an officer or not for being a shareholder. You're paying them for being a guarantor. That's really what drives that guarantee fee. And Paul, there's a question there about the sources of data for RC reports. I'll let you take that.
Absolutely, and I can tie that possibly into some other sources of data as well, and then I'll ping you on that as well, Stephen. So RC reports, we saw a picture of Bill Schneider a little earlier. Before we use any, I call it foundational data. So foundational data is data that is gathered in a methodology that is credible, as well as in quantities to be reliable and credible. And the organizations that absolutely do that the best are our governmental agencies. So Census Bureau, State Departments of Labor, Bureau of Labor Statistics, they all do that. And that is the primary source of our foundational data. That being said, about 40% of our data you could probably find out there, depending on where you looked. It is public source. The other 60% of our data is proprietary, and a significant portion, more so than our cross-industry, as our industry-specific data is proprietary. And again, a lot of that is outlined, at least the parts that we are able to share in that methodology report. So when somebody asks what other sources of data would you suggest using, some of the ones I already touched on, RMA, ERI, MGMA. If you're going to use them, just know what the shortcomings are and blend them in or weight them appropriately. But look at other government sources as well. Check your state's Department of Labor, BLS, as well as Census Bureau. Stephen mentioned a little earlier, they can be difficult and cumbersome to use, which is true. You have to value, what your time is versus finding that data, but that data is generally considered very reliable and very credible. Stephen, do you have any other sources that you'd recommend?
Not necessarily. Salary.com is one that I get some promotions from. I'm not real familiar with it though, so I can't recommend it to you, but I do get some promotional materials from them from time to time. But there's a lot of them out there, and we talked about trade associations and things like that, so a lot of different sources out there. But when you defend your report, you need to defend your source of your data. So you need to understand, where do they get their data? What quality controls do they have in place? How do they sort it? How do they deal with outliers? How do they deal with duplicates, and so forth and so on? So just be prepared to defend your source of data as well as defend your opinion.
Well, great. On behalf of BVR, I want to thank Stephen and Paul for their presentation, and I want to thank all of our listeners for attending. If you'd like to learn more about RC Reports or would like to subscribe, you may visit bbresources.com to find a link to the product under the Deal and Market Data menu heading. You may also contact sales@bbresources.com to learn more. We hope that you will join us on June 8th for our webinar on understanding control versus lack of control and applicable discounts. Again, to receive your 2 CPE credits, you must complete and submit a brief survey on this webinar within 5 business days. If you choose to fill out the survey now, your browser will automatically redirect to the CPE credit page when I finish speaking, so don't disconnect. A link to the survey is also provided in your login email and on the reading page for today's webinar. The survey will be active for 5 days and must be completed before we can process certificates. After 5 business days, we'll process CPE and send your certificates via email. If you have any questions related to the content or format of this webinar, please email training@bbresources.com. Thank you all for listening, and have a great rest of your day.